Hey there, I'm the Contentious Investor, and today we're going to be taking a look at Chris Cole's paper, The Allegory, the Hawk and Serpent. I am not a financial advisor, and I prefer not to be sued. For this reason, this video should be utilized only for educational and entertainment value, and not as financial advice. Before investing, you should always do your own research, no matter how much you trust the ideas of some madman on the internet. I also tend to be way too brief, so feel free to berate me with questions in the comment section, clarifying or otherwise. Anyways, back to the Allegory, the Hawk and Serpent. In this paper, Chris Cole proposes a portfolio called the Dragon Portfolio, a passive investing strategy that is designed to perform well in all market conditions. He backtested the strategy from 1928, forcing the portfolio to have to perform well in a variety of market conditions, whether it be through the Great Depression, World War II, the inflation in the 1970s, or the zero-bound interest rate environment of the 2000s. The reason such a portfolio is necessary is because modern portfolios simply do not work before the 80s. Almost all popular strategies today involve a combination of both U.S. stocks and U.S. bonds, so to examine the pitfalls of such a portfolio, we should examine each asset separately. A link to the paper will be provided in the description below, and I highly recommend taking a look at it, as many of the details were oversimplified or skipped over to keep the video's length reasonable. If a portfolio consists of 100% U.S. stocks over the last 90 years, it would have had serious issues during the period of the Great Depression, as well as during the period of secular stagnation of the late 60s through the early 80s. While the 70s appear to be positive as shown in gray, these charts are not inflation adjusted, and stocks performed extremely poorly during this period. Also note that this chart, as well as all others in this video, are on a logarithmic scale, and that certain charts utilize a larger scale than the one shown for equities. The problem with holding exclusively U.S. equities is that the portfolio will suffer extreme volatility during downturns, during which most people will panic sell. During deflationary periods, the portfolio often does so poorly that it takes decades to break even in nominal terms, never mind the actual loss of purchasing power when one adjusts for inflation. Treasuries had a far worse return overall, barely making a return in the period of 1929 to 1983. While it appears to have made a rather impressive performance over the last 40 years, much like stocks, this is a function of central bank manipulation ever lowering interest rates, which is a phenomenon that is impossible to continue without deeply negative interest rates. To say the least, that would be completely unfeasible and counterproductive, as people would withdraw all their savings from the banks and hoard money rather than the intended effect of stimulating the economy. Diversification is the practice of combining two asset classes that are inversely correlated in order to improve returns over using them independently. You can combine any two of assets A, B, and C, having each of the two chosen assets comprising half of your portfolio. The portfolio that consists of asset A and asset C will do far better than a portfolio of asset A and asset B, despite the fact that asset C did worse than B and actually lost money overall. These increased returns are possible due to rebalancing. As asset A gained value, it was sold off to buy more of asset C in order to maintain the 50-50 split. In doing so, assets A price appreciation results in the sell-off of asset A into asset C, leaving with more of asset C when asset A takes a downturn. During that time, asset C performs well, causing the portfolio to barely lose money during that time period. Meanwhile, as asset C does well, it sells off into more of asset A, coming full circle, and the cycle repeats. A popular way to take advantage of diversification and rebalancing is the 60-40 portfolio, which is comprised of 60% stocks and 40% bonds. This portfolio did better than the 100% equity portfolio in every one of the time periods shown, with less volatility and less risk. The 60-40 portfolio also did better than the 100% treasury portfolio in every period except for the Great Depression. Unfortunately, this portfolio does have a fatal flaw. Treasuries and equities don't actually move inversely to one another. They have since the 1980s, but that is only because central banks have continually lowered interest rates every time there's been a recession. In times where this hasn't happened, such as before the 1980s, treasuries and stocks are actually highly correlated with one another, making them more act like a combination of assets A and B from the previous slide rather than assets A and C. Since interest rates are already at zero, it is nearly impossible to lower them any further, as doing so would result in deeply negative interest rates, which would have a variety of negative effects on the economy, and is therefore unfeasible. Both stocks and bonds are serpent assets in the Dragon portfolio. The serpent can be boiled down to being periods of secular growth, the good times of ever-increasing economic prosperity. Eventually, however, all good things must come to an end. The serpent is unable to get any more growth naturally and begins devouring itself. People increasingly turn to bad debt due to a lack of actual growth, whether that be taking out credit card debt, over-leveraging themselves on the stock market, or taking out corporate loans in order to buy back shares. This is how the S&P 500 managed to go up 30% in 2019, despite no increase in corporate earnings. This cycle also happened right before the Great Depression, before the stagflation in the 1970s, and is currently happening right now. The general public typically has over 100% exposure to the serpent. During the good times, they boom, as they get to take advantage of the wealth effect as the value of their assets on paper soars. Most people think that they're not utilizing leverage while they're investing, but that simply isn't the case. You wouldn't go and buy stocks with 5 times leverage. You think it's reasonable to buy a house with a 20% down payment. Those are the same thing. There's a reason why that's a bad idea with stocks. If the stocks go down just 20%, your equity goes to zero. Any more and you're underwater. Right now, houses are just as overvalued as they were during the Great Financial Crisis, which was a housing bubble. This is on top of your investments in tax-protected accounts, such as 401ks and IRAs, which are almost exclusively invested in U.S. stocks and bonds. On top of that, your job is also likely highly correlated to the market. When the economy does poorly, your job is at jeopardy, or at least at risk of a pay cut, and your tanking investments aren't going to provide much of a cushion to help you from defaulting on your highly leveraged mortgage. Hawk assets are ways to make money during periods of secular decline. The hawk destroys the serpent, which is devouring itself, either through its deflationary or inflationary wing. During deflation, people with debt get wiped out, such as during the Great Depression. During inflation, people with fixed-rate debt are rewarded, while those without assets suffer. For those of you with a fixed-rate mortgage, inflation will be a gift. Your investment and wages may plunge in real terms, but your mortgage will go to zero as you pay it back in what is effectively green toilet paper. As shown in the chart, most of the time things are very stable. However, almost all of the gains and losses in a portfolio come from the extreme moves that happen once a decade. If you situate your portfolio properly, you can profit from these dramatic swings, whether they be the upside or downside. One way to play this is active long volatility. Explaining this would warrant its own video to get into the weeds of the various option strategies to play this, but essentially it is a way to profit from the extreme moves to the up or downside at the expense of missing out on steady growth. As shown in the chart, in red and gray, during the periods of decline, long volatility did well, while during other periods it flatlined or even lost money. A great way to look at this asset is as if it was asset C, important for diversification's sake, but a terrible asset to hold for any other reason. Commodity trend following plays a similar role to active long volatility, doing amazing during periods of decline but being a poor strategy during periods of growth. Once again, similar to active long volatility, getting into depth on the strategy would warrant its own video, but essentially you go long when commodities are heading up and short when they're going down. You will do quite poorly as the commodities change direction, but thankfully they tend not to be particularly swingy. Physical gold is another crucial component of the Hawk portfolio. It is the most stable asset of all time, holding its purchasing power for all of recorded human history. Outside of other precious metals, nothing from even the formation of the United States has kept its value, whether it be stocks, real estate, or even fiat currency, or should I say especially fiat currency. Due to being on a gold standard up to 1971, the price of gold did almost nothing for the first 40 years on the chart. Note that the redemption price did increase from $20.67 to $35 in 1933 after Roosevelt confiscated America's gold in order to debase the currency. Gold does extremely well during periods of inflation, as seen in the 1970s, while flatlining during deflationary periods. Gold's the best wealth preservation tool that exists for a reason. Chris Cole notes in the paper that cryptocurrency may also be an interesting addition to the portfolio. He comments that, quote, cryptocurrencies such as Bitcoin have similar characteristics to gold, as there's a limited supply, they exist outside the system, and in theory they can be valued using a stock-to-supply model. Despite this fact, while gold has performed over the last 4,000 years, the verdict is still out on Bitcoin and other currencies like it. The value of those currencies is either infinite or nothing. There are substantial questions regarding custody, security regulations, and liquidity, but the benefits outweigh the risk when sized appropriately. The prudent investor may consider owning cryptocurrencies, speculative, and sized appropriately to the high risk. Shown below is the stock-to-flow model, which is what he was referring to when he was talking about the stock-to-supply model. That model states that Bitcoin should be worth at least 100K right now. Obviously, there was no data to backtest with, but as a highly asymmetric and non-correlated asset, it is an extremely attractive addition to a portfolio, but should probably not be any more than 5 to 10% of the portfolio, if even that much. Much like the 60-40 portfolio, the Dragon portfolio utilizes diversification in order to increase returns. Based on the backtesting data, this allocation of roughly 20% in each asset class leads to the best results in the 90-year period. The rebalancing between the assets forces the portfolio to sell assets that are getting expensive when it rebalances every year and buy the ones that have underperformed and therefore cheap, similar to the dynamic between assets A, B, and C. This is why the Dragon portfolio has performed so well since 1928. Fortunately, as investors of the brain, we have the ability to utilize the advantage of rebalancing between the Hawk and Serpent in more intelligent ways than passive investing ever could. Right now, Serpent assets are at their most overvalued levels in human history, while Hawk assets have never been cheaper. This is why I'm 100% Hawk assets at the moment, which can allow me to leverage the exponential gains that I expect to happen in these asset classes. While having so little exposure to the economy is unfeasible for most people due to 401ks and mortgages, reallocating assets from wildly overvalued to wildly undervalued assets is advised. Keep in mind, this is still not financial advice. I've already gotten immense gains from the precious metals that I expect to continue, and cryptocurrency is probably next. If you're not invested in Hawk assets, don't worry, as the gains have barely started. Wealth is never destroyed, it only changes in form, and hundreds of trillions of dollars of value need to change from toxic derivatives, fiat currencies, overvalued companies, and real estate into hard assets. The assets are still in their linear phase and haven't yet begun their exponential returns. None of us will ever see another opportunity like this again in our lifetime, and I, for one, intend to take advantage of these life-changing investing opportunities. Fortunately, there has never been a better time in human history to put on these trades. It has never been easier for a retail investor to invest, with no commission platforms and the endless knowledge of the internet from people like yours truly. Fortunately, we now have the opportunity to utilize cryptocurrencies such as Bitcoin and crypto savings account, such as those on Crypto.com, in order to dramatically amplify returns without having to utilize leverage. However, this video is already running extremely long, so I'll have to pick this up in part 2. If you got any value from the video, feel free to like, subscribe, and ask your questions in the comment sections below. And check out the paper with the link in the description below, as I said at the beginning of the video. This has been The Contentious Investor. Until next time.